Imagine holding like the absolute most important piece of real estate in the $2 trillion artificial intelligence boom.
Right.
I mean, you literally manufacture the physical infrastructure that keeps the entire AI revolution from melting down. Demand is so high that customers are practically breaking down your door.
Yeah, unprecedented demand.
Exactly. But then imagine that despite all of that, your profit margins on this groundbreaking tech just completely plummets to roughly 6%.
It's a massive paradox.
It really is. And that is the exact paradox you're looking at today with Supermicro. That is SMCI. Welcome to the Byte-Size Brief. Today we're putting SMCI completely under the microscope. Let's get right into it.
Yeah, thanks. It is arguably the most complex dynamic in the market right now. We're sitting here in May 2026, and SMCI is undeniably at the epicenter of this massive technological shift. But the stock is hovering right around $27 to $28 a share, which is down significantly from its historical highs.
Which is just baffling if you only read the headlines, you know?
Yeah.
You look at the broader landscape, and the demand for compute power is just insatiable.
Totally.
But clearly, being the backbone of the AI boom doesn't automatically make your stock invincible.
No, it doesn't. And that is exactly our mission for this deep dive. Our goal today isn't to get swept up in the broader AI hype or try to, predict what happens 10 years from now.
Right. Let's stick to the data.
Exactly. We're going to look at the cold, hard facts from just the last 3 months. We're talking recent SEC filings, the Q3 earnings previews, and recent CEO letters. We really want to objectively assess where SMCI is heading right now.
I love it. Okay, let's start with the technology itself. Because before we get into the financial red flags, and I mean, those margin numbers are definitely startling, we need to establish what's actually driving this massive demand.
For sure.
Why are the biggest tech companies in the world, these massive hyperscalers, buying SMCI hardware at a record pace? What is the physical mechanism actually giving them an edge?
It basically comes down to thermodynamics. Right now, SMCI has this massive $13 billion backlog tied directly to Nvidia's Blackwell Ultra systems.
13 billion. Wow.
Yeah, that number alone shows the sheer scale of the demand. But the real moat, the thing that physically separates them from legacy competitors, is their direct liquid cooling advantage, or DLC.
Okay, let's break that down for a second. Because when people think of a data center, you usually picture these giant rooms with massive air conditioning units just blowing freezing air down the aisles, right?
Right, the traditional hot aisle, cold aisle setup.
Yeah. So why isn't that standard air cooling approach working anymore?
Well, it's because of the sheer thermal density of these new chips. So a traditional CPU might draw, a couple hundred watts of power, but the newest generation of AI GPUs, they're drawing over 1,000 watts each.
Oh, wow.
Yeah. So when you pack dozens of those into a single server rack, the thermal output is just staggering. Traditional air cooling physically cannot move enough thermal energy away from the silicon fast enough.
So the air just gets saturated?
Exactly. It doesn't matter how big your fans are or how cold the room is. Air is simply not dense enough to absorb that much heat.
Okay, so it's literally a physics bottleneck.
Exactly. So direct liquid cooling routes fluid, usually this highly specialized coolant or water, directly over the hottest components using these closed-loop microchannels.
Gotcha.
And here is where you really have to look at the industry metrics to understand SMCI's lead. Currently, they're shipping 30% of their products equipped with this direct liquid cooling.
30%, okay.
Yeah, and the industry average for new data center deployments right now is hovering around just 5%.
That is a massive gap. So basically, SMCI is building the absolute best high-performance radiators for the hottest engines in the world.
That's a great way to put it.
I mean, let me see if I can visualize the physics here for you guys listening.
Yeah.
It's essentially the difference between, standing outside on a 60-degree day versus jumping into a swimming pool filled with 60-degree water.
Right.
The air feels perfectly fine, maybe a little brisk, but the water will drop your core body temperature almost immediately because water is denser and absorbs heat exponentially faster.
That is the perfect analogy. And the business result of that cooling efficiency is spatial density.
Meaning they can fit more stuff in the same space.
Exactly. Because the liquid pulls the heat away so effectively, you don't need to leave empty space between servers just for airflow. You can pack way more GPUs into the exact same physical footprint. In fact, SMCI's liquid cooling technology can actually increase a data center's rack compute power by over 2 times.
Which is incredibly valuable. I mean, considering data centers are super constrained by physical real estate and just the local power grid, if I'm a massive cloud provider, you tell me I can double my computing power without having to buy the building next door, I'm buying your hardware immediately.
Precisely. And they are delivering this hardware with unprecedented speed. They use what they call a building block architecture.
Like Legos for servers.
Yeah, exactly. Instead of custom engineering every single server from scratch for every client, they have these highly standardized modular components that just snap together seamlessly.
Which perfectly explains the whole Memphis project. I mean,
Yeah.
they famously built the Memphis data center, which houses 100,000 GPUs in just 122 days.
Right.
Building a facility of that magnitude usually takes a year, maybe 2.
Yeah, it was a total watershed moment for their operational reputation.
But, okay, hold on. This is where the narrative hits a massive wall for me.
Okay.
If their tech is this essential, and they have a $13 billion backlog, and they're dominating liquid cooling, and they just built a 100,000 GPU facility in 4 months, why isn't the stock price reflecting that dominance? Hold on, how does that actually affect SMCI's stock price for regular investors like me? Why are we sitting at 28 bucks?
It's a great question. And it's because building the best hardware in the world doesn't automatically mean you're making good money on it. And this brings us directly into the financial realities. The demand is unprecedented, yes, but SMCI's profitability is shrinking dramatically.
Let's hear the damage.
Let's look at the numbers from their Q2 FY 2026 report because they perfectly illustrate this exact tension. So their revenue absolutely exploded to $12.7 billion.
Wow.
That is a 123% growth year over year.
I mean, doubling your revenue to over $12 billion in a single year is staggering. You usually only see those growth percentages in, like, early-stage software startups, right? Not capital-intensive hardware manufacturers.
It is massive growth, but the market isn't rewarding them for it because of the associated costs. Their non-GAAP gross margin suffered a steep drop, falling to just 6.4%.
Okay, let's clarify that for a moment for the listeners. When we say gross margin, we're talking about the profit they make just on the physical goods, right?
Right.
So if they sell a server rack for $100, after they pay for the Nvidia chips, the copper piping, the steel, and the labor to actually assemble it, they're only keeping $6.40.
Exactly. And that's before they even pay for their corporate overhead, their global sales teams, or their internal R&D.
Oh, man.
To put that drop into perspective, that 6.4% gross margin is down 310 basis points quarter over quarter.
So they basically lost over 3% of their core profit margin in just 3 months.
Correct. And when you finally factor in all those other operating expenses, the sales, the marketing, the engineering salaries, their actual operating margin hit a razor-thin 3.7%.
That leaves almost zero room for error. Like a slight delay in shipping or a small bump in the price of raw materials, and that 3.7% profit easily turns into a loss.
Very easily.
It makes you wonder what management's actual strategy is here. I mean, you look at competitors like Dell or Hewlett-Packard Enterprise, they aren't operating on margins this thin. Are they essentially selling servers at 0% profit just to steal market share?
Well,
Is this like a brilliant blitzkrieg business tactic to lock in customers for life? Or are they just bleeding cash?
It certainly appears to be an aggressive market share acquisition strategy, but you're right, it comes with a severe financial penalty. And to understand the gravity of that penalty, we have to look past the income statement and examine their cash flow.
Always follow the cash.
Always. This is the mechanism that really brings that 123% revenue growth back down to earth. In Q2, despite generating $12.7 billion in sales, SMCI's operating cash flow was actually negative $24 million.
Wait, negative $24 million? They sold $12 billion worth of hardware, and more cash went out the door than came in. How does the math on that even work?
It's all about the cash conversion cycle in hardware manufacturing. Scaling at this speed is incredibly expensive. When SMCI secures an order for that huge backlog, they don't get paid immediately.
Right.
But they do have to immediately purchase billions of dollars worth of inventory. The GPUs, the memory modules, the specialized liquid cooling manifolds, all of it.
So on day one, billions of dollars flow out of SMCI's bank account to their suppliers.
Exactly. Then it takes time to receive those parts, assemble the complex server racks, test the liquid cooling systems for leaks, which takes time, and physically ship them to the customer.
And even then, they don't get paid right away.
Right. Enterprise customers typically have 30 to 90 days to actually pay the invoice. So SMCI is carrying the financial weight of these massive builds for months before they see a single dollar of revenue return.
Wow.
They're prioritizing rapid growth and market dominance over short-term cash flow, and they are aggressively bleeding cash to do it.
Well, that makes perfect sense. The faster you grow a physical product business, the more cash you burn just keeping the assembly line fed.
Exactly.
Okay, so compared to last quarter, what actually moved the needle here? Because despite burning cash and seeing margins compress, they still issued a very aggressive $40 billion revenue guidance for the full year.
Yeah, they did.
So what tangible moves did they make in April 2026 to prove to investors they can handle this scale?
They actually executed 3 major operational upgrades this past April to try and optimize that exact manufacturing bottleneck.
Okay, what was the first one?
First, they unveiled a massive 32.8-acre data center building block solutions campus right in San Jose, in the heart of Silicon Valley. It's their largest domestic facility to date, designed specifically to boost their AI factory capacity here in the U.S.
I have to pause you right there because that seems incredibly counterintuitive. Real estate and labor in Silicon Valley are notoriously some of the most expensive in the world.
Very true. If your gross margins are currently bleeding out at 6%, why would you build your biggest manufacturing hub in one of the most expensive zip codes on the planet? Why not build it in the Midwest or Texas, where overhead is a fraction of the cost?
It's a fair question, but in the AI infrastructure race, proximity and time to market are vastly more valuable than cheap land. You have to remember, they are integrating brand new, highly complex liquid cooling systems with bleeding-edge GPUs.
Right. It's not simple tech.
Exactly. By keeping their manufacturing and integration services physically next door to their global engineering headquarters, they can solve problems instantly. If a microchannel leaks during testing, the design engineer can literally walk across the street to the assembly line to redesign it.
Oh, okay.
You just cannot troubleshoot next-generation hardware efficiently if your engineers are in California and your assembly line is across 3 different time zones.
Okay, that makes sense.
Yeah.
You are basically paying a premium for speed and quality control. What was the second move?
The launch of the Gold Series enterprise servers. This is a lineup of over 25 pre-configured, optimized server systems designed specifically for AI and edge computing. But the differentiator here isn't just the hardware itself, it's the logistics.
Logistics out.
SMCI guarantees these servers are ready to ship within 3 business days from their warehouses in the US, Taiwan, and the Netherlands.
3 business days. That is basically unheard of in enterprise hardware.
It really is.
Usually you place an order for a server rack, and you are waiting weeks, if not months, for custom fabrication. How are they managing to ship complex AI servers in 3 days? This sounds like Amazon Prime for AI data centers.
It kind of is. And they do it by taking a calculated risk on inventory. Instead of waiting for a customer order to begin assembling the server, SMCI is predicting demand. They're pre-integrating these 25 specific configurations and letting them sit fully assembled in global warehouses, literally ready to be put on a truck.
Which completely removes the friction of waiting for a customer. I can see why an enterprise client would absolutely love that. But wait, going back to our cash flow discussion.
Yeah.
Holding thousands of fully assembled liquid-cooled AI servers in global warehouses must tie up an astronomical amount of cash up front. Won't this drag their cash flow down even further before we see any real payoff for SMCI?
It absolutely does, which is why the market is watching these moves so closely. It is a massive bet. If the demand holds, they capture that revenue instantly. But if demand softens, they're left holding extremely expensive inventory.
A huge risk.
Which leads to their third strategic move in April, their aggressive expansion into ARM-based platforms and Open Compute Project, or OCP, systems.
Okay, when I hear Open Compute Project, I assume that means these servers aren't locked into some proprietary ecosystem. Like, it sounds like they want their hardware to be the universal puzzle piece for any data center. Am I on the right track?
You're exactly on the right track. The Open Compute Project is an industry-wide standard for data center hardware design. It was originally spearheaded by the major hyperscalers because the big tech companies hate vendor lock-in.
Right, they don't want to be held hostage by one brand.
Exactly. They don't want to be forced to buy proprietary racks from a single manufacturer forever. So SMCI is aggressively rolling out these systems to ensure their hardware slides seamlessly into the open source architecture that these massive cloud providers actually demand.
It's a really smart sales tactic.
Yeah.
They aren't trying to force you to change your data center's architecture. They're just offering the most power-efficient, liquid-cooled version of the exact standard you already use.
Precisely. It removes another massive barrier to the sale. But to your earlier point, the ultimate test of all these April initiatives, the Silicon Valley campus, the 3-day shipping, the open compute integration, will be the upcoming Q3 earnings.
The moment of truth.
Exactly. Investors will be watching to see if SMC and actually hit their guided $14.3 billion to $14.7 billion revenue mark for the quarter, while simultaneously proving they can stabilize those gross margins at their expected 6.72%.
Because if revenue grows, but margins slide to, say, 5%, the market will punish the stock, regardless of how fast they can ship a server.
Absolutely.
Expanding operations is really only half the battle here. If you look at standard valuation models, even with compressed margins, SMCI's revenue growth is so vast that the stock should theoretically be trading way higher than $28. So we have to address the elephant in the room.
The governance and trust issues.
Exactly. We have to look at the massive non-operational shadow hanging over this stock to understand why the valuation multiples remain so low.
Right. And to evaluate the stock objectively, we have to look at the recent U.S. Department of Justice indictment.
Right. And just to be clear for the listeners, we're looking at this strictly through the lens of business risk and market trust.
Mm-hmm.
We're not taking sides. What exactly is happening and what is the company's official stance?
Based purely on the facts as reported, the DOJ recently unsealed an indictment regarding export control violations. Specifically, this involves allegations of restricted silicon chips being smuggled to China.
Okay.
If we look at the letter issued by SMCI's CEO, Charles Liang, on March 24, 2026, he laid out several key facts from the company's perspective.
And what was the core message to investors there?
First, and most critical from a legal standpoint, SMCI as a corporate entity is not a named defendant in the indictment.
Oh, really?
Right. The CEO stated that the company itself was a victim of elaborate schemes orchestrated by rogue individuals who basically managed to deceive both federal authorities and SMCI's internal compliance protocols.
So the argument is that this was the work of bad actors circumventing the rules, not a systemic corporate strategy directed by the company itself.
Exactly. And the letter detailed the immediate actions taken. The identified individuals have been fired. Furthermore, a member of the board of directors resigned.
Okay.
And to rebuild their compliance framework, SMCI promoted Deanna Luna to acting chief compliance officer, and management stated they're implementing far more rigorous oversight on their global export control systems.
I mean, I understand the legal technicalities there, but if you're managing a massive enterprise fund, or if you're just a regular retail investor, trust is an incredibly fragile currency on Wall Street.
It really is.
Regardless of who was specifically named in the indictment, the presence of a DOJ investigation, board members resigning, and emergency compliance overhauls, that creates a massive cloud of uncertainty.
Definitely.
Hold on. How does that actually affect SMCI's stock price for regular investors like me? Doesn't this constant cloud of drama effectively cap any potential rally, no matter how good the earnings are?
Yeah.
I mean, we saw that uncertainty materialize into an actual business loss recently, didn't we?
We did. It had a highly tangible impact on their pipeline. SMC recently lost a massive server contract with Oracle.
And this wasn't a small order, right?
Not at all. Reports indicated the Oracle deal was worth somewhere between $1.1 billion and $1.4 billion. We're talking 300 to 400 server racks.
Wow.
If you're an investor, you have to look at that and realize how heavily this governance issue weighs down the stock. If a massive hyperscaler like Oracle is willing to walk away from a $1 billion order, it's likely because they are conducting their own vendor risk assessments and are spooked.
Yeah, supply chain security is huge for them.
Exactly. And doesn't that put the entire $40 billion annual revenue guidance at risk?
It definitely puts it at risk.
And that is the exact dynamic suppressing SMCI's valuation right now. Wall Street can model for low margins and they can model for high capital expenditures, but they cannot model for unpredictable legal risk or the sudden loss of enterprise trust.
Yeah, the market hates uncertainty.
Exactly. This specific overhang is why the broader market consensus currently rates SMCI as a hold, with the average price target sitting right around $35.
Which is fascinating because if you strip away the DOJ headlines and just look at the math, some models show they are deeply undervalued based strictly on future cash flows.
Mathematically, they are, but the market is applying a heavy trust discount. Even if the core manufacturing business is performing brilliantly, the loss of the Oracle contract proves that governance issues bleed directly into operational realities. Large enterprise clients crave stability above all else.
So the burden of proof is entirely on SMCI right now. They have to prove that these export control issues are contained and firmly in the past, and that their new compliance structure is bulletproof.
Yes. It all boils down to whether the upcoming Q3 earnings can finally drown out the noise and validate the company's aggressive strategy. If they print a massive revenue beat, but operating margins compress further and cash flow remains deeply negative, the stock will likely struggle.
But if they can show they're stabilizing those margins, moving toward positive cash flow, and they reiterate that $40 billion guidance without losing any more major clients, maybe the market will finally look past the governance shadow.
It's possible.
It really is the ultimate tug of war between unprecedented AI demand and these concerning governance and margin issues.
It is a precarious position. And, as we look at the broader trajectory of this technology, it raises a much larger structural question about the industry itself for investors to mull over.
Oh, where do you see this heading?
Well, SMCI is standardizing liquid cooling. They're aggressively pushing open compute systems. If they succeed perfectly in their mission, this incredible, highly complex AI hardware effectively becomes commoditized.
Just standard equipment.
Exactly. It becomes standard plumbing for the data age. And historically, when infrastructure becomes commoditized, the profit margins rarely recover to their previous highs. So, if SMCI manages to fix its margins while maintaining this level of revenue growth, could this current price be the discount of the decade? Or is the systemic risk simply too high and margins will just race to the bottom?
Man, that is a fantastic point. Are they the undervalued backbone of the future, or are we just watching the commoditization of hardware play out in real time? All right, listeners, what's your take on the future of SMCI? Are you bullish, bearish, or sitting on the fence? Let us know in the comments. See you next time on the Byte-Size Brief.